Thanks very much. Welcome back. 5 minutes past the hour. It is my privilege, indeed my honor, to welcome back Chuck Malamut for 25 years. It's 2.5 decades. The official financial advisor to Hurley in the Morning. Chuck leads the Malamut Group at Morgan Stanley's Northfield office for all of your financial planning needs. You can turn to Chuck and his team, 609-383-2010. The following program segment is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck and do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided here today nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. The presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Chuck, with all that fanfare having been said, welcome back to your program.
Good morning, Harry.
Oh, you're on a different mic, but I'll fix that in just a second. Go right ahead, Chuck.
Good morning, Harry. How are you today?
Good to see you. How are you?
So it's simply amazing how in a relatively short period of time, all the eyes are now off. Think about it. We were here last week. Greece, China, Puerto Rico became, the major focal point. And as we got to the end of last week, well, things changed, and they changed, rather dramatically in a positive way. The NASDAQ, all into itself, Harry,
set a record.
Had a fantastic week. It was up over almost 4.25% for the week, closing at 52.20. The Dow, respectable gains almost at 2% for the week, and the S&P advanced almost 2.5%. And while all that was happening, the yield on the 10-year that we look at, daily, basically fell 7 basis points from 2.41 to 2.34, and as a result, with decreasing bond yields pushes bond prices higher. And there's a lot to be said, and I think, we kind of chatted about it last week about Greece ready to go to the vote, and the vote went as expected. I was actually a little more pessimistic about it than you were. I was just sort of sleeping with one eye open, thinking that in spite of all the turmoil, that they would, try one more time to say, okay, we're not going to go for this, and actually
they couldn't. Remember, I guaranteed.
And the austerity that was put in was actually worse for the Greece than it was when they started this crisis several weeks ago.
See, the reason we're such a perfect team for 25 years and even before that in another life is finance, I know politics. There was no way they had, and this really stung, because they voted and approved a substantially worse deal than they could have had in the first place. How you like those apples?
Well, I think when you get your back against the wall and you really don't have much choice, it kind of forces you to say, okay, live or let die. So, the question is, are we really at an inflection point, and is Greece really ready to suck it up?
No, Chuck, here's what it is.
And do the right thing here.
No, I promise you that this is 6 months. That's all this is. Is anybody talking about that, Chuck? This is just a 6-month type deal.
No, I think what happened was, now that we are in the throes of second quarter earnings, and for the most part here, domestically, the majority of the earnings that we've seen so far have either met or slightly beat lowered expectations. All eyes are focused here domestically, and all of those discussions,
they're just happy it's kicked the can for a little while. Happy.
You haven't seen any more graphics of or footage showing everyone lined up at the bank to draw cash out of the ATM, and
they still can't get the money.
You're right, and so, but you think about how perverse the world is sometimes, that that was front and center, and no matter where you went, it was over all the media sources, and now all of a sudden it's sort of taken a back step, even though not a lot has changed. I mean, if you're a Greek resident, I mean, you still are living under that government and in the guise of that government, and if you want to
send your own money, say you have a family member somewhere else, you can't even send your own money. Who wants to live like that? They have to dramatically change something that was totally unsustainable. And to me, I'm happy that the markets have settled down and have accepted this, but I don't see really anything that's dramatically going to change the way that they run that country until they're ready to actually change. And they're really not ready to change.
Harry, I think you're right. I think they're not ready to change, and chances are, in our lifetime, they probably won't change.
But who's going to keep bailing them out?
Well, you get to the point where maybe you get your back against the wall, and then all of a sudden that the
philosophy,
the EU says, we're not going to help you anymore.
Right, and I think we're at the last straw, and they'll just kick them out, because socialism is great until you run out of other people's money to pay for the way that you want things to be. That's where Greece is at right now. They're running out of other people's money to spend.
So we'll see if, in fact, any changes, do take place with that particular country. But remember, one of the things we talked about last week, even though it was front and center for about 10 days, 2 weeks, you couldn't get out of the way of hearing about Greece. They represent such a minor piece of the economy in Europe. And then when you look at the global economy, it's basically a speck.
But they have
nothing.
such a disproportionate impact, though, on so many markets and even markets outside of Europe.
Well, I think the biggest concern, and again, this goes back to the last time Greece had their back to the wall, the potential contagion. Countries like Portugal, Spain, Italy, even France to a certain degree were not as financially stable then as they are today. And as a result, the event was viewed differently this time than it was, 5 years ago for sure.
Chuck, quick time out. We're coming back in just 60 seconds, a mini break. You're listening to the official financial advisor to Hurley in the Morning, Chuck Malamut, the Malamut Group of Morgan Stanley's Northfield office. For all of your financial planning needs, turn to Chuck and his team. 609-383-2010. That's 609-383-2010. For more than 20 years, the D'Amato Law Firm has served as the official lead counsel to the Hurley in the Morning program. Led by certified civil trial attorney Paul D'Amato, the D'Amato Law Firm focuses their practice in representing those who have been seriously injured in construction, products liability, and motor vehicle collisions. The D'Amato Law Firm expertly handles cases throughout the country, but their primary focus is on representing victims injured right here at home in southern New Jersey. They've earned a reputation for excellence. From direct personal experience, I can readily confirm that the D'Amato Law Firm's overall competence, attention to detail, follow-up systems are outstanding, and they truly shine during your moment of truth before judge and jury. The D'Amato Law Firm is centrally located in Atlantic County at 2900 Fire Road, Suite 200. That's the second floor in Egg Harbor Township, New Jersey. That's the corner of Fire Road and the Black Horse Pike. For all of your personal injury legal needs, turn with confidence to the region's leader in the field of personal injury. They're the D'Amato Law Firm. Call 609-926-3300. That's 609-926-3300. And please tell the D'Amato Law Firm that Hurley in the Morning sent you. Thank you very much. That was the birthday boy, Paul D'Amato, just from this past Sunday. Yesterday, my son's birthday, Robert. Big birthday for him, and we had a great day. And also Muriel Elliott's birthday yesterday. We talked to Bill about that. Chuck, back to you.
So Paul was just turned 45, correct?
45. He'll owe up to that. Yeah, 45.
So we beat up Greece, and when you take a look at, again, the world in China, so to speak, economically, seems to be a lot better than it was several weeks ago. And what was happening, because of that stabilization, some real solid earnings last week here in the U.S. for the second quarter. That propelled the market in the NASDAQ to basically an all-time high. If you take a look, and Harry, as you know, we're not going to talk about individual stocks. We never do that. But it was pretty remarkable what happened in the tech industry, tech sector on Friday when Google announced their earnings. And the stock was up 11, 12%, for the day, which basically propelled the NASDAQ, to those all-time highs.
President citing. Ruble. Go ahead, Chuck.
So in any case, as we finished up the week, I think we're now at that glass half full phenomena versus the glass half empty, and we are, focusing clearly on earnings. Earnings for the most part yesterday were good. Earnings today, Verizon beat their number. United Technologies, I think, was slightly off, and there was a third company reporting this morning that beat as well. So we're getting some mixed signals, but
mostly good, though, right?
But what is happening is that you have to remember that as we got to the end of the first quarter and we had that negative 0.2% growth for the first quarter, analysts went in and downgraded earnings. So now, you lower the bar and companies are beating those numbers. But the reality is year after year, or on a comparative basis, earnings aren't up as significantly as we would like them to be. And there's Harry, one of the things that we have talked about is, and we continue to talk about, is the consumer. Remember that three-legged stool theory with respect to the economy?
Yes.
And the consumer needs to be a very, very vibrant part of the economy. But what is happening last week, and actually we were here last Tuesday, retail sales came and they were off fairly significantly from the projected number. And the fear that we had was that, oh my gosh, what's going to happen now with the consumer? The consumer is not spending. And a lot of this goes back to, think about in 2000, as we got to 2007, 2008, where it didn't matter. Anyone could get money for any particular purpose. And it was the banks were fairly loose. The mortgage companies were in a position where they were lending money. So what is happening? What we're waiting for is that our consumers going to go back to the old way of doing things, where if they had a dollar in their pocket, were they going to spend 3/4 of that? Harry, chances are that multi-decade debt binge, as it's referred to, which was supporting household consumption prior to the financial crisis, it's over. It's not happening right now. I mean, and we see it here, locally with what is happening with real estate, certainly, and the loss of jobs, as you and Tim Mancuso were chatting about earlier this morning. But at the end of the day, even if you take South Jersey, out of the equation, so to speak, nationally speaking, what is happening, consumers, they're just not spending. So if you we went back here and when we looked and we analyzed this. So if you go back between 1945 and 2007, before the financial crisis, household debt ended up growing at an average annualized rate of about 9%, much faster than nominal income growth. And that trend, which eventually hit that wall, remember in 2007, where the first thing, the banks shut down all the equity lines. It didn't matter if you had a $100,000 line, you had $10,000 outstanding, so you had the availability to draw $90,000. The banks basically came in and said, "That's it." With these declining prices of real estate, your home equity line is now frozen. So that piggy bank, as it's referred to, that hit a wall in 2007. So that ended up, presenting a major tailwind for household spending. Historically, household consumption has increased by roughly 0.2% for every 1 percentage point increase in household debt. Well, that's not happening right now. The recession ended. Household debt has been growing at a much slower pace, less than 1% annualized. So as we go moving forward into the future, it's not clear whether, and I hate to, we're in this category, the older, still indebted households. I mean, that's you and I, we're not certainly, 20, 30, 40 years old. We're part of that group. And I think a lot of your listeners are as well. So what is happening is that even if borrowing is slow, debt levels are still well above the long-term average, but consumers right now are just not spending. And that is a real concern, for all of us, as we look at the equity market. So you have to be very, very careful. It's not just when investors say, "Well, I'm just going to buy the S&P 500," because it's the stock market, and that's fine. But when you really go in and do a deep dive as to what we just chatted about with the consumers, you have to be really careful about buying certain sectors.
Chuck, quick time out. We're going to come right back, and I do have a follow-up about this, what I think is the reason that spending is down. When people are confident and they know they're going to keep their job and they know the next paycheck is going to be there, people spend freely when they feel good about the economy. I think people are not spending because they don't trust this unprecedented economy that's growing, if it's growing at all, fractionally instead of in a healthy way. And there are 76.4 million baby boomers in America today. Malamut and Hurley represent two of them. Welcome back. 22 minutes past the hour. Left you with a cliffhanger, Chuck. The question I want to ask you is, we know that the consumer spending is down. Do we know why it's down? I just said my theory as we feathered into the break. To me, it's a confidence, a lack of confidence in this economy.
Harry, I will agree with you to a certain extent, but there are some positive things that are happening with the consumer. And you mentioned that awful word yesterday, last week, when
talking about the R word.
When you asked me about the first quarter and then what was going to look like the second quarter, and doesn't that represent the big R word? And I walked out.
Oh, you cringed.
I walked out and I shivered. But wage growth is there right now. And we don't, it's real challenging for us because of where we are, where we live. We don't see that. But even though you had, weak retail sales, you've had that drop in oil prices.
Right.
And you've also had, what you're seeing now is that the labor market is getting a little bit tighter. And as a result of that... Well,
then why was first quarter GDP negative 1.7 or whatever it was?
Well, actually it was zero. It was minus 0.2.
Okay, well then it was that number first. Then it got downgraded even further upon review. So maybe you're telling me that it's been changed again, but it was really getting downgraded further. But let's put it this way:
I think your point's well. I think your point's well taken. That the fact is that the world we live in today, where the expectation of a 2% GDP is acceptable. I mean that's really. I think that's where you're going with your question,
which is totally unacceptable. And I always remind our listeners that back in 1992, 4.6% GDP was considered the worst economy in 50 years. Now we're going to be thrilled if we're at 2%, and we have a candidate for president who has a decent shot, I think, of getting the nomination, who says we have to get back to where we're growing at least 4%. Well, when this guy's father was president, he was growing at 4.6%, and he got thrown out of office because it wasn't good enough, and it was the worst economy in 50 years. And then we get told, Chuck, this is the new norm. This is like intellectual dishonesty on steroids.
I think, Harry, the countdown is certainly on until November of 2016. And if you take a look at what our friends have done in Washington over the last several years, or actually 6+ years, where the statement was made that it's all about hope and change, the reality is that it's become very, very difficult for any business, to continue to ramp revenue, decrease expenses, and get that money to the bottom line. So whether it's a large publicly traded company, whether it's a private company that has several hundred employees, or maybe even just that mom and pop corner store, so to speak, I think we are all suffering under the guise of what has happened over the last 6+ years. And I think we're all kind of looking forward to hopefully that you turn the page, so to speak, and you begin a new chapter in the book, and then we are growing at 4% per year.
Something that I would talk about on Hurley in the Morning, and I have, that we wouldn't necessarily talk about on Malamut in the morning, but I think it's a fair comment even within your financial program, Chuck. The Fed, I like what the Fed chair, I mean, I don't know if I agree with it, but it showed sort of backbone and chutzpah a little bit. The Fed, I think, enjoys its independence very much. And there was a certain congressional committee that was asking the Fed basically to testify. And the Fed chair, I'm pretty sure I have this straight, basically told them to go pound sand, and we're independent of you. I thought that was pretty good.
I think that when Janet Yellen began her term, I think there was she
was like Clint Eastwood.
No, there were a lot of.
No, I meant now.
Right now, I mean, there were a lot of people that were very, very fearful of her taking over.
I was concerned,
and you can see in a relatively short period of time, I think she's pretty remarkable what she does.
I think she's been steady.
And, what she is doing to the fixed income markets and actually the equity markets as well is not that they're broadcasting in advance what they're doing. They certainly can't do that. But they've made it perfectly clear that if all the economic numbers line up, that there will be a rate hike relatively sooner than later. So now
what they've been consistent.
They've been transparent.
Transparent too, but also consistent, because you can be transparent and all over the place. They've been transparent and consistent. So markets, Chuck, better than anybody that I know. Markets like to know where things stand. And I think with Janet Yellen so far, where she stands.
Well, Harry, as she testified last week, I mean, I read some of the notes, and here was her exact quote. What she said was, if the economy evolves as we expect, economic conditions likely would make it appropriate at some point this year to raise the federal funds rate target, thereby beginning to normalize the stance of monetary policy.
Proving this is abnormal.
So, when you look at the analysts that cover, the strategists that cover the Fed, and where we go with rates, now because of what I mentioned to you earlier this morning with respect to a tighter labor market, earnings being somewhat better than expected, not only here but also globally, most of the strategists seem to believe that rate hike is going to come in September, fewer in December, and then there's a very, very small minority that say there will be no rate hike this year. It could potentially begin in 2016.
Brief timeout. He is Chuck Malamut, the official financial advisor for Hurley in the Morning. We entered on July 1st, our 25th year together here at WPG Talk Radio 1450, South Jersey's talk station. Chuck heads up his group, the Malamut Group, at Morgan Stanley's Northfield office, and for all of your financial planning needs. And think about it, whether you are expecting a child or you have young children, Chuck will help you with college building. He can help you with vacation planning, with retirement planning, wedding planning, all these different things. Sit down with Chuck. You'll be very, very impressed with his perfected concept of total asset management and proper asset allocation. 609-383-2010 to meet with Chuck and his team. We'll be back in just a few minutes. Stay with us. One more power segment with Chuck Malamut, our official financial advisor. He leads the Malamut Group at Morgan Stanley's Northfield office for all of your financial planning needs, 609-383-2010. And Chuck is going to be with us until about 8:45 this morning, coming up at 10 minutes before the top of the hour for the rest of this 8 o'clock hour, the award-winning Janice Dean. And if you've ever watched Fox News Channel or the Fox Business Network, Janice Dean is the weather machine. She does the weather, and she's also a best-selling author, and we're going to be talking about both coming up in the final 10 minutes of this hour. Dr. Newkirk is a game-time decision, and then I know at least the second half of the 9 o'clock hour is wide open for him. Chuck, back to you.
Harry, we left off talking about the Fed and what the next move is and when it's going to happen. And again, most strategists are of the opinion that they're talking September for the rate hike. But when you look beyond what is happening here in the U.S. and you look globally as far as the monetary policy set outside the U.S., very, very accommodative. You think about what was happening over in Europe. They basically went, because they are somewhat behind us, so to speak, as far as their progress. They put in that QE. That seems to be working. So when the Fed does begin to raise rates, which again, expectations probably September, unless they're hit with a slew of economic reports that go the wrong way, they're going to be slow, and they're not. Remember, many years ago, I think when Greenspan was in charge of the Fed, and you looked at the chart, and it was like a stair step, up every Fed meeting, you would go up a quarter, up a quarter, up a quarter, occasionally a half, and then you moved, you moved, I think 500-600 basis points in a relatively short period of time. That's not going to happen here. I mean, even if you have a handful,
it's a totally different time.
If you have a handful of rate increases here in the U.S., it's still going to be very, very low based on historic standards, and that kind of goes back to what we chatted about with GDP and lack thereof and low interest rates. So, monetary policy outside the U.S., should still provide, a boost to global economic growth. So even though earnings are up, 1% compared to where they were, a year ago, chances are that I would rather be in that camp of the glass being half full than the glass being half empty at this point in time.
Chuck, I know we're going to talk about Iran, and of course that takes us to a discussion about oil, but I think this whole normalization, if you will, even though they're not quite calling it that, once you bring Iran back as, one of the nations that is at the United Nations level, they'll be in good standing. They're going to be on committees. They already are on some United Nations committees. The embargoes and the different economic sanctions that have been in place are going to be gone. Russia can't wait to do business with them. China, France, other nations, and it's not just oil, Chuck. They're going to do other things with Iran. Iran is going to spur economic growth, aren't they?
Harry, I think,
except for us.
Yeah, I think when you look at what transpired over the last several weeks, the immediate attention went right, to their oil supply. And if you look at what was happening with the price of oil, it dropped fairly dramatically as the thought process was that there would be a significant supply, coming to the market, very, very quickly. Now, they are the fourth, right now, they are the fourth largest proven reserves in the world. And they have the potential to increase the world's supply of oil, and you use the word "but" with a capital B, it's going to be slow, and to come online. It's not one of these situations where, all of a sudden, you turn the spigot tomorrow and it all starts to flow. So we don't think that it's going to have a real major impact initially on world oil markets. Maybe in the future. But not right now. So, you think about it. We stopped buying Iranian oil back in 2010, and the EU only began those prohibitions in 2012. China, India, they continue to be consumers of Iranian oil products, and if this demand from the emerging markets, kept Iran on the list of top exporters, but even with those sanctions, Congress and Parliament, there's a lot of work to be done. We think it's a drop in the bucket with respect to global oil trade. So I think that what happened in the oil markets last week, it was fairly volatile. And if you look at the price of West Texas from where we were a year ago, it's down, over 50%. We were at $103.15. Closed last week at $50.88. The price of unleaded at the pump, $3.64 a year ago. Now we're at $2.83. So it's not, you don't have that direct correlation. As it gets produced and ends up at the pump, but certainly it all gets back. You think about, to the consumer, you've had a drop at the pump. And that's not getting back that relief in taxes, so to speak, we'll call it, is not getting back into the economy. And again, that's what we chatted about fairly early this morning.
What time?
Fairly early this morning.
Thank you.
The concern again is the consumer, and how and to what extent will the consumer, get into their pocket and actually spend like they did previously.
Chuck, we are 3 weeks into the third quarter. Is this year playing out a lot different than we thought it would?
Harry, we have been through a tremendous amount of volatility, and it seems as if it only subsided just recently it seems like the last several days. Like yesterday was a virtually a nothing day in the markets. And think about it, you're in the heat of the summer. You have a lot of people on vacation. August is going to probably be slower than July, but you think about it, the market has ended up withstanding a lot of pain, a lot of pressure points, and has done relatively well in over that time period. So we seem to believe that equities will continue, but you need to be in an upward bias, but you need to be selective. One of the things that we chatted about for several weeks, the need to be invested not only domestically but internationally, and we seem to think that Europe, has a fairly long way to go, positively speaking, with the growth of their equity market. So, again, if your listeners have not taken heed to that advice, then shame on them, because as we look at getting into last week, the Italian market, the German market, the FTSE, the Euro Stoxx 50, they have all outperformed the domestic here, U.S. NASDAQ and S&P 500 and Dow Jones.
Chuck, a little over 3 minutes left in your program. Now that we're in the second half of this year, and soon we'll be 1/3 into the third quarter in 9 days or thereabouts, 10 days, 31 days in July, are there things that people should be doing, generally speaking, in terms of looking at how they're positioned and going into the second half?
One of the concerns that we had last year as we got to the end of the year was the fact that mutual funds ended up with some surprises and unfortunately created a lot of taxes to the shareholders. I would, and mutual funds usually never give you this much advance notice, but if you can, if it's available, you might want to find out if there's any embedded capital gains that are going to be passed through to the investors, and that is a concern. But the one thing that you need to take a look at is that we've been through a lot of pain over a relatively short period of time.
One thing I think we have gotten very good at, and you've talked about this a lot on your show weekly, Chuck, I think we've gotten, we'll get your take on it, I think we've gotten very good at our financial markets, being able to handle geopolitical events, as you call them. They don't seem, they'll maybe hit hard, but they seem fleeting in nature, and a lot of times our markets have been very, very solid to kind of flick them off like a bug. Like, don't even let them bother you. You don't even have to swat the fly as it goes by. You just don't even react to it. It seems as though we're handling these things better, maybe because there's more of them.
Well, Harry, I think that it's not so much as there is more of them, and if you take a look at Greece all into itself and China and Puerto Rico, those were three separate events, and I think the media, really wanted to create coverage, and I'll use the word hysteria, particularly in Greece, and it's not. I'm not. I don't want to say it's not bad that what's happening there.
They were promoting contagion, Chuck.
Well, they were, and if you think about. And you watch any of those publications, if you watch it for 30 minutes, you're going to catch pretty much everything that's going on, and then it's just the tape just re-racks and you hear it over and over and over again. It's like anything else, Harry. If someone tells you something 10 times, you're going to believe it. And if the world, if in Greece is coming to an end, and that's what's being broadcast, you're going to say, hey. Chuck, I think Greece is coming to an end. What do you think? But that has been a lot of that has been created, and I'm not making light of what happened there, but I think when you really look at statistically what it represents in the Euro zone and in internationally, it's really not much of anything. And the contagion's not going to happen.
Chuck, I agree. As always, great to be with you.
Thanks, Harry. We'll see you next week.
Look forward to it. Chuck Malamut, leading his group at Morgan Stanley's Northfield office, 609-383-2010 for all of your financial planning needs. The following program that you listened to was presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this program are those of Chuck and do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. We'll be back. If all goes well, we have a date with the award-winning Janice Dean, the weather machine from Fox News Channel and Fox Business Network. And we're going to talk about the hurricane season in general and Janice's newest book. She created this character, the Frogcaster, and I believe this is the third in her children's series. We'll be back with Janice in just a few minutes.